Welcome back to Commercial Connections Podcast. I'm Brittany, and this is our Multifamily Minute, the segment where we take what can feel complex or overwhelming in the Eugene Springfield multifamily market and slow it down into something clearer and more usable. Today, we're talking about appraisals, specifically what it means when an appraisal gives you two very different values for the same property. We're walking through a real local appraisal scenario. Names are anonymous, but the situation is one we often see: a property with a significant gap between its as is value and the prospective value after renovations. Rene, this appraisal shows an as is value of around $270,000 and a prospective value north of $520,000. That's a kind of a spread that can feel exciting or confusing depending on how you look at it. Let's start with the basics here. When an owner sees two values like that in one appraisal, what's usually the first reaction?
Well, most owners usually anchor to the higher number. A seller wants to go with the higher number, which is understandable. But if you're the buyer, you want to know, why are there two values? Because it comes with a completely different set of questions. So the as is value, this would be what the property would sell for today in its current condition. And the prospective value, that might be what the property is worth in the future, assuming everything goes according to plan and that the buyer does the improvements to the property. And the second value is not a promise, it's just a scenario.
And that distinction matters more than most owners realize, would you say?
It really does, especially in today's market. This property that we're talking about, I recently helped some buyers acquire it, and it had been on the market probably 18 months. And because of the condition, there just were not a lot of offers coming in. So it definitely makes a big difference on how you're looking at a property.
And in this appraisal, the property is described as being in poor condition, like you said, with a lot of deferred maintenance. How does that factor into the values, like the skinny down version?
Well, deferred maintenance is really about risk. When a property has visual issues, roof concerns, structural repairs, outdated interiors, buyers and lenders don't just discount the cost of repairs, they also discount the uncertainty because unknown things, risks with, is the roof really going to cost X amount of dollars to cure? And it slows down transactions. It tightens the lending because fewer lenders want to be involved, and it compresses the value. So in this case, the appraiser determined that curing the deferred maintenance would move the property from poor to average condition because the building, it was vacant and it was not really habitable. But luckily my buyers have the skill and ability that they're going to go in and make improvements to it. So that shift materially reduced risks, which is why the prospective value increased so dramatically. And really, it's critical because the value only increases if the work is completed as assumed.
Could you expand on that a little more about how that relates to the current market?
Yeah. So, like in this situation, the appraiser, when he's looking, he or she, when they're looking at a property and it's in rough condition and they're giving an as is value and then a future value, what they're saying is, I'm taking the information that's provided to me and I'm assuming that it's accurate and I'm assuming that it's going to be cured. So, the prospective value assumes that the renovation budget is accurate, the work is completed as specified, costs don't materially change, and then that the market conditions don't significantly change before completion. If any of those variables shift, the prospective value may no longer hold true. And that's why owners don't treat prospective value as a guaranteed outcome. It's really a conditional estimate. That's why an owner can't hang their hat on that higher value and say, well, I want that higher dollar amount. It's like, yeah, that's once the work is completed. So you don't get that number today because you didn't do the work. The buyer is going to do it.
Yeah. And I think I've seen this on another property that we've done a PPE on, but I think before there was like five buildings and four of them needed new roofs. And when they put it on the market, they had one roof done and then they had bids for the other three. And is that something that you see commonly? And how well does that bode with buyers? Like, do you think they like seeing that? Or it's still kind of like the same to them? Like, well, you didn't do the work. Yes, maybe you have the bids built in here, but does that make sense?
Yeah, it does make sense. We often have to negotiate that because a roof bid will often they'll only guarantee that number for like 60 to 90 days until you sign the contract and pay your deposit. And then they'll kind of guarantee the number. But materials, building materials change night and day, especially if there's tariffs or international wars or just different things that impact materials coming in or out of the United States, then that impacts building materials. And so roofs, timber, wood, different things that have to go into renovations, that really makes an impact. And so a budget can change overnight.
Yeah. So just seeing that bid on there isn't really the peace of mind for a buyer that the seller might think that it is.
Well, the only thing that I would say is if the seller had a bid and the buyer called and talked to that roofing company and they knew that roofing bid was good and the seller was either going to give a credit directly towards the sales price so that the buyer could actually see that discount, or they were going to hold that in an impound account with the title company and then have the roofs completed once the transaction closed and then pay the bid, then I would say, yeah, that is an okay situation from the buyer's perspective. But you're right. If they've only done one roof and they're like, well, we just decided to put it on the market, we ran out of time, we don't want to do the other roofs, a buyer is probably going to have an issue when they go to obtain a loan because the lender is going to say, we want those roofs completed before we're going to be able to close the transaction. And more importantly, I can guarantee you the insurance companies are now going to do that. I recently had coffee with an investor who buys student housing and campus properties, and he renovates them and then he either decides to keep them in his portfolio or he flips them and resells them. And he bought a property recently for cash and he couldn't get insurance on it until he put a new roof on it, but he had already committed a short closing window, so he had to pay cash for the property and then immediately put a roof on as quick as possible so that he could get insurance on it.
Wow. I mean, that's a really great example of like the deferred maintenance. Yeah. And like the issues that come with, when you're ready to buy and sell. But I think that was a great case example of what people should be looking out for.
Yeah, absolutely.
So going back to this specific appraisal, the renovation budget here in this appraisal says it's roughly $180,000. How should owners think about whether that spend actually makes sense for the dollar amount?
Well, sometimes I have an owner call me and say, should I do these improvements to the property before I put it on the market? And often I say, well, it depends. If you're selling it to a passive investor, yes, it makes sense to cure some deferred maintenance. But like in this situation, this buyer is going to own or occupy this property. They're going to move their HVAC and their electrical company into this building. And so they got a great SBA loan. They were able to incorporate in the $180,000 that they needed for renovations. And for them, it made sense because they're busting at the seams in their current location. Creating this new one will allow them to almost double their workforce, bring on more electricians, more guys that can bolster their HVAC division. So it makes sense in that situation to go ahead and spend the money. But before you're committing to the capital, an owner should ask which improvements are mandatory versus optional, and
Mm,
even a roof, because if somebody's selling, putting on a new roof is not going to benefit them because they're about ready to sell and walk away from that property. But on the flip side, the roof is also at the end of its life. And so if you weren't going to sell, you would have to put a new roof on most likely anyway. So what I typically recommend in a situation like that is just split the cost of a roof because that's fair and equitable to both parties. But sometimes there are repairs that are going to be done and you have to look at them to figure out if they're going to improve income or the building, or are they just functional things that a seller thinks, I want to do this to the property because it'll look better.
Yeah. I think that makes perfect sense. It's like there's not always one way or the other. I like your advice, the splitting it down the middle, giving that equitable, fair split to both parties. But like in this case, it actually made sense for them to come into a property that needed a bit more reno and they needed it for their own specific needs. And they had like certain things they wanted to bring. So I didn't even think of that as like, oh, sometimes someone might want a space that needs some work because they need something very specific in their commercial building that they wouldn't be able to find in another commercial building, but that they can get at a little bit of a lower rate and hope maybe build it out in that space. Is that kind of like what's happening here?
That's exactly what's happening. And it's a really smart move for these buyers because the building was basically being sold as is. And so this electrical and HVAC company, they're going to be able to go in, put in HVAC, put in new electrical, do some LED lighting, and they're going to be able to basically finance those repairs into their loan through SBA. They were able to get in with a lower down payment since it was owner occupied. And really, the appraisal supported that the strategy was the right move for them because when the appraiser looked at the value, he factored in that $180,000 renovation budget.
And if you're listening to this and thinking, I need clarity on my own portfolio, Renee is now offering free pinpoint price evaluations. And if you're also interested, we have a 2026 Eugene and Springfield apartment market snapshot. And we also have a copy of our latest U of O market snapshot available as well. You'll find all of those links in the show notes. Those two snapshots are great tools if you're looking to get invested with a commercial property in either of those markets. These are two great tools for understanding where you would be positioned in today's market. So, this appraisal that we're talking about today also leans on the income approach with a projected NOI around $38,000 and an overall cap rate of 7.5%. How should owners interpret that in today's market?
Well, cap rates are really a reflection of how the market votes and perceived risk. And in the Eugene Springfield environment, higher financing cost and cautious buyers are pushing cap rates up slightly, which puts downward pressure on values. As I mentioned, this property, I think, had been on the market like 18 months. And they just hadn't received a lot of offers. So it's important to note, and I had just touched on it briefly, but when the appraisal was completed, they reconciled both of the value by looking at it from a sales comparison approach where they looked at like and similar properties that sold. That's called a sold comparable approach. And then they looked at it from the income approach of if there was a tenant in this occupying it, they were paying rent, here's what the rent would be, here's what the expenses would be. And then they back in using a capitalization or a cap rate. And that really tells us that the assumptions were consistent because the appraiser demonstrated that the value was supported using either of those approaches. But that consistency doesn't eliminate market risk. It just frames it. It just basically says, here's the risk, here's the exposure. So, like in this situation, the cap rate was 7.5%. If you called me and said, hey, what's a multifamily apartment complex selling for? We might be in a 6.5% cap rate. And that's because there's less risk. It's not an older building that's been sitting vacant that has a lot of deferred maintenance. So that's why this property sold at a 7.5% cap rate because it was deferred and had been sitting vacant for quite a while.
Yeah, that makes sense. This property is located in a sector of Eugene that is considered a secondary commercial corridor. How does that affect long-term thinking?
Well, secondary corridors can provide opportunity, but they really ultimately reward patience. So often it offers visibility and flexible zoning because sometimes you might be included or wedged in some residential allowances. And that sounds attractive, but sometimes zoning permissions doesn't automatically mean feasibility. And what we see is like in this situation, if they wanted to expand the building, there's businesses on both sides of them. So there's no room for them to expand. So this current location is as big as it's going to get. Now, they could demolish it and build up and build two-story if they wanted, but that doesn't really make sense when you're talking about, having garage roll-up doors so you could roll your trucks in at night and things like that. It's more of the building is as it is, and the highest and best use isn't always redevelopment. Sometimes it's stabilizing the asset, curing the deferred maintenance, and then letting the market cycle turn and see, if interest rates go down, these guys will probably refinance. If values go up and they do a lot of improvements to this, they may want to sell this building and bootstrap into a larger building down the road in the next couple of years. So that's another thing that they could consider.
And the appraisal suggests we're still in a cautious phase of the market with longer exposure times and conservative underwriting. What does that mean for owners right now?
It really means that expectations need to be realistic. When we see a disconnection between a seller's memory of peak pricing and a buyer underwriting today, that gap slows down deals because the buyer has to go and talk to their lender typically and qualify. And so we're using current market cap rates and current sales prices, but a seller's thinking, yeah, but 2 years ago, I had somebody step in off the street and offer me $1 million for this property. Well, the problem is they didn't take that offer then. And so it's one of those things that you have to look at the timing of the market and where you're at right now. And sometimes holding, renovating, refinancing, or selling can all be correct decisions, but it depends on your goals, your tax exposure, and your tolerance for complexity.
Yeah, that absolutely makes a lot of sense. If an owner brought you this appraisal and asked, "What should I do next?" where would you start?
Well, it depends on if it was the owner or the buyer. If an owner brought it to me, I would not start with the value. I would start with what are you trying to do? Are you trying to do a 1031 exchange? Are you trying to get out of a management burden? What's your long-term goals? If it's a buyer, then I would say, what's your plan to renovate? How are you going to make this building habitable? Are you going to move your business in, or do you want to buy it and then put a tenant in it? Are you going to use sweat equity? Are you going to be able to renovate? I mean, there's just a bunch of different scenarios, kind of almost like a thinking tree that it could split several different directions. And it just really depends on who the person is that's asking the questions. But the appraisal is a great starting point when we're in the middle of the transaction to validate the information, but it doesn't create the strategy. You already have to have the strategy in your mind of what you're doing and where you're going. The appraisal is just confirming market facts.
Yeah, it's just data points. So, how many times do people bring you appraisals, if ever? And that would be like the first time you guys connect.
Most of the time, not because they will typically call me if it's a seller and ask for a pinpoint price evaluation because they're trying to establish in their mind what their property is worth and should they sell. So they're trying to figure out I call it their jump off point. What's their price? What could they get for it? How long is it going to take to market and get an offer and close on the transaction? And then we decide if we're going to list the property, put it out on the market, and then a buyer would be the one that would go to a lender, and then the lender would order the appraisal. Now, there are times when somebody will have like estate issues, maybe somebody passed away, or they're splitting up a family LLC or a family partnership, and they'll reach out to like Zoe Schwartz It's an MAI appraiser that we've had on our podcast before, and she'll complete an appraisal for them. And then once they see the number, then they're like, oh, okay, well, I guess I'll sell. So then an owner would call me with an appraisal in hand because they had just had that done for estate purposes. And now it's motivated them to sell and go ahead and take the money now.
Yeah, so let's close out with a few clear takeaways. What would you tell people to keep in mind specifically when it comes to appraisals?
I would say be open to the value because the market is changing right now and renovations do not automatically create upside. Cap rate is what is driving values, and it's not just math. There's a bunch of things that go into it. It's condition of the property, any deferred maintenance, as well as cap rate risks. Zoning flexibility does not necessarily create feasibility and high interest. And the right decision depends on the goals of either the buyer or the owner and what they're trying to do. It's not just a number that I'm going to give them, it's what are they trying to accomplish.
Yeah. If you're finding yourself thinking, I need clarity on my own portfolio, Rene offers a free pinpoint price evaluation. You've probably heard it mentioned out through this episode. If you are interested, please check our show notes for that link down below. That is the free pinpoint price evaluation where we will get your information and then connect you and do a deep dive on that property and the portfolio. And we also have a set of market snapshots. We have our latest set from the Eugene Springfield apartment market snapshot, and in addition to, we have the University of Oregon's latest snapshot. Those are both available. Links are in the show notes, and that will take you directly to those downloadable snapshots. And if today's episode was helpful, we would be so grateful if you would leave us a quick review on Apple Podcasts. You can also find us on YouTube, Spotify. Please give us a rating, review, leave us any comments of questions that you have regarding these episodes. And as a special thank you, we are running a drawing right now. So if you do leave us a review on Apple Podcasts and you send us a screenshot of your review to our IG at René Nelson Real Estate, we also do a monthly drawing for a chance to win a copy of Chris Voss's Never Split the Difference. We recommend this book because his negotiation principles are really great for multifamily owners, especially if you're navigating offers, inspections, or partnership conversations. He was previously an FBI negotiator, so he knows all the good tips and tricks. Thank you for listening to this episode of Multifamily Minute, and we'll see you next time.